Vancouver's mortgage stress just hit levels not seen in over a decade, and it's not a market correction, it's a crisis of survival for hundreds of thousands of families. Right now, as you're watching this, mortgage delinquency rates in Greater Vancouver have climbed to 0.36%, according to CIBC's latest earnings report. That's a climb, and the Real Estate Institute of Canada projects these numbers will continue soaring, potentially reaching depths not seen since the 2008 financial crisis. But here's the cold truth that makes this different. This isn't about prices falling. This is about 1.2 million Canadian homeowners, your neighbors, friends, and co-workers, facing mortgage renewals in 2025, representing over $300 billion in total debt. These aren't speculators flipping properties, these are families who locked in rates below 2% during the pandemic, and they are now staring down renewal rates of 4.2% or higher. The math is brutal, unforgiving, and deeply personal. A $500,000 mortgage that felt manageable at $2,118 per month is about to jump to nearly $2,700 at renewal. That is a 30% payment shock, hitting all at once. That's $7,000 extra per year that has to be pulled out of thin air. The central question isn't whether Vancouver's housing market is breaking down, the data already confirms that. The question is how deep this goes, and what happens when the mortgage cliff meets negative equity, rising unemployment, and a rental market that can't absorb the distress. This is the raw, emotional anatomy of a housing market in complete distress. And the clock is ticking for hundreds of thousands of households across Metro Vancouver. Before we go deeper into the cold, calculated reasons Vancouver is on the brink, let me ask you, are you prepared for the next 12 months? Are you making the 7 critical mistakes that are currently destroying home equity across Canada? If you want to know the truth and protect your investment, or even use this moment to find an opportunity, you need to stay informed. Hit that subscribe button right now and turn on notifications. We track the data, expose the speculation, and show you how to navigate a market that's turning against the average person. Don't let your biggest investment become your biggest liability. To understand the sheer panic in Vancouver, we have to rewind to a time when borrowing money became essentially free. Back in March 2020, the Bank of Canada slashed its policy rate to 0.25%, and instantly, 5-year fixed mortgage rates dropped below 2%. Variable rates plummeted to 1.5%. For the first time in a generation, the cost of capital approached zero, but there was a darker, deeply relatable dynamic at play that most people didn't see: the heavy, emotionally fraught weight of multi-generational leverage. According to 2021 data, nearly 18% of properties owned by younger Canadians were co-owned with their parents. This wasn't just a simple gift for a down payment, this was the bank of mom and dad putting their entire financial future on the line. Parents, rich in home equity but often on fixed retirement incomes, were taking out home equity lines of credit, HELOCs, or co-signing mortgages, stacking their own assets and credit risk on top of their children's maxed-out borrowing capacity. It was an act of love, yes, but also one of profound systemic risk. The moment rates started to climb, the structural fragility became apparent. If the younger generation loses their job, can the parents, who are navigating medical expenses or fixed-income retirement, cover the full mortgage payment? The dream of generational wealth was suddenly tied to a debt structure that, under pressure, could wipe out 2 generations of financial stability at once. The betrayal arrived in March 2022. The Bank of Canada, in a desperate attempt to contain inflation that had spiked to 8.1%, began the fastest monetary tightening cycle in Canadian history, rocketing the policy rate from 0.25% to 5% in just 18 months. The dream of low payments evaporated instantly. Variable rates soared above 6%, and the pain for those homeowners was immediate and absolute, with some monthly payments nearly doubling. The market, once a white-hot frenzy of bidding wars, simply froze. Sales volumes collapsed, with Metro Vancouver recording 14.3% fewer sales in October 2025 than the year prior, well below the 10-year average. Buyers, who could still afford to purchase, watched from the sidelines with no urgency, thinking, why buy today when prices are falling and might be lower next month? Listings piled up, climbing 13.2% year over year. Houses that used to sell in single digits of days now sat for 30, 40, sometimes 60 days or more. Sellers who expected bidding wars now struggled to get a single offer. This created a profound, soul-crushing psychological conflict. Then, the psychological floor broke. Prices began their descent, slowly at first, but by late 2025, the reality was undeniable. Detached homes in Vancouver that held a firm $1.9 million floor in early 2024 fell below that level in the autumn. Once a psychological support level shatters, panic sets in. Sellers who had held out for higher prices realized they had missed their window, now facing a stark choice between selling at a loss or holding a massive liability. But the real emotional wound is negative equity. When home prices fall 15% to 20% from the peak, as they have in several Vancouver submarkets like parts of Burnaby and Coquitlam, anyone who bought with a standard 10% or 15% down payment is now underwater. Industry reports suggest over 20% of homeowners who purchased between 2021 and 2022 are already in negative equity positions. These aren't greedy speculators, these are the nurses, teachers, and tech workers who saved for years, who believed they were making a safe, long-term investment in their family's future. Now, they are trapped. Imagine the shame, the sickening knot in your stomach, watching the equity you poured your savings into disappear. They can't sell without having to write a massive check to the bank to cover the difference between what the house is worth and what they owe. They can't refinance to a better rate because lenders won't approve a mortgage for more than the home's current depressed value. If they lose their job or face an unexpected medical bill, their options simply evaporate. They are stuck, drowning in a debt that is now greater than the value of the asset it secured. This isn't just a paper loss, this is a massive derailment of life plans, and the pressure is building with every passing month. The next phase of the crisis is where this stress meets the cold, hard logic of the financial institutions. The real conflict isn't between buyers and sellers anymore, it's between the trapped homeowner and their lender. Banks began increasing their expected credit loss provisions in late 2024. These provisions, reported in quarterly earnings, aren't speculation, they are actuarial math, a signal that financial institutions expect a wave of inevitable defaults. When a bank sets aside massive capital to cover potential mortgage losses, they are looking at real-time borrower stress indicators, employment trends, and loan-to-value ratios. CIBC's 90-day mortgage delinquency rate hitting 0.36% is small in absolute terms. Roughly 1 in 278 mortgages is at least 90 days delinquent, but it's an early warning signal. The bank's chief risk officer, Frank Gu, told analysts that rising delinquencies in Greater Vancouver were very well in line with what we expected, linking them directly to higher unemployment, the high interest rates, and the continued weakness in housing sales. Translation: the economic pressure is real, measurable, and accelerating. Historically, delinquency rates follow the increase in expected credit losses by 6 to 12 months, which means the banks are preparing for a wave of defaults that hasn't materialized yet, but that their sophisticated risk models deem inevitable. They are watching a ticking clock. The conflict is intensely magnified by that silent killer, negative equity. As home prices have fallen 15 to 20% from their peak, anyone who bought with less than 20% down, especially in 2021 and 2022, is now underwater. These are not the speculators. These are the responsible citizens who scraped together their savings for a 10% or 15% down payment, believing they were making a safe long-term investment. Negative equity turns a manageable financial hardship into a terrifying trap because it completely removes all optionality. If you lose your job, you can't sell to downsize or escape the payments because you would have to bring tens of thousands of dollars to closing just to get out of the debt. You can't refinance for a better rate because their home no longer provides adequate collateral. You are stuck in a house that is worth less than the debt you owe on it, with no financial emergency exit. The personal wealth built over a decade is wiped out, life plans are shattered, and the only choice left for the homeowner is to absorb the payment shock or eventually be forced into default. This is the agonizing reality the banks have already factored into their risk models. But the ultimate test of survival is coming, and it's set for a specific date on the calendar. Here is the precise moment where economic theory meets raw, Painful reality: over 1.2 million fixed-rate mortgages worth more than $300 billion are set to renew in 2025. The vast majority, more than 85%, of these mortgages were originated when the Bank of Canada's policy rate was at or below 1%. These homeowners locked in a low-rate fantasy between 1.5% and 2.5%, and they planned their entire lives around those fixed, predictable monthly payments. They bought cars, had children, made career moves, all underpinned by their belief that their largest expense was secured for 5 years. Now, that period of stability is ending. The new renewal rates are not 2%, they are 4.2%, 4.5%, or sometimes higher. Let's look at the unforgiving math. A $500,000 mortgage goes from about $2,118 to approximately $2,700 per month. That's $582 more every 30 days. A $750,000 mortgage payment jumps a staggering $873 per month, or nearly $10,500 annually. This isn't money you absorb by simply cutting out streaming subscriptions or skipping lattes. This is structural, deep-seated financial stress that hits a household's most basic budget. The crucial data point is this: can the average household absorb that shock? The answer, increasingly, is no. Many of these borrowers barely qualified at the time of origination. While stress tests required them to prove they could handle a rate 2% higher, a 4% rate for a 2% contract, the current renewal rates are often higher than the rate they were tested at. They are now being asked to afford something they never proved they could, and they are doing so with a home that is worth less as collateral. The worst part is that their financial buffers are completely exhausted. The extra savings built up during the pandemic lockdowns depleted. Credit card balances climbed to new highs. Home equity lines of credit, HELOCs, drawn down to cover the rising costs of food, transportation, and utilities. There is nothing left to cushion this devastating renewal shock. They are entering the most financially challenging period of their lives with no safety net. The pressure is compounded by the shame of their predicament, the feeling of having worked hard, saved, and done everything right, only to be betrayed by a system they trusted. They are facing an income-to-debt ratio that is unsustainable, and the system is simply waiting for the inevitable moment they miss a payment. But the crisis doesn't end with the homeowner. It's a silent financial massacre hitting the investors next. The traditional escape route for a stressed housing market, the ability to sell and downsize, or to rent out a property to cover the mortgage, is totally broken in Vancouver. This is the shocking truth about the rental market: it can no longer rescue anyone. Investors who bought properties, assuming rental income would easily cover their mortgage payments, are now facing the grim reality of negative cash flow. This isn't speculation. BNN Bloomberg reported that in the Greater Toronto Area, 81% of leveraged condo investors were in negative cash flow, losing an average of nearly $600 per month after accounting for all expenses. Vancouver's numbers are similarly alarming. Let's use the terrifying example of a typical investor who bought a one-bedroom Burnaby condo for $650,000 in 2021 with 20% down. Their $520,000 mortgage at 2% was costing them about $2,200 per month. Even with rent at $2,400, adding in strata fees, taxes, and insurance meant they were already losing $625 per month, a total loss of $7,500 annually. They were bleeding cash, betting on massive price appreciation to cover the loss. Now, their mortgage renews at 4.5%. Their monthly payment soars to $2,900. Suddenly, their monthly loss explodes to $1,325, or nearly $16,000 per year. They can't raise the rent significantly because the tenant base is also under pressure and vacancy rates have ticked up slightly. They certainly can't sell without taking a devastating loss, because the condo is now worth less than what they owe. They are trapped in a relentless, unforgiving cash flow bleed with no obvious exit. This individual tragedy creates a dangerous feedback loop that accelerates the crisis for everyone else. Desperate investors try to sell to stop the hemorrhaging of cash, which adds overwhelming inventory to an already weak market. Vancouver's mortgage stress isn't a walled-off problem in the housing sector. it's a cancer that ripples through the entire regional economy in deeply consequential ways. When tens of thousands of households face mandatory payment increases of $500 to $1,000 per month, that money has to come from somewhere, and it comes directly out of reduced consumer spending. It's the skipped family vacation, the delayed car purchase, the cancelled subscriptions, the deferred medical treatment, and the eliminated visits to local restaurants. This massive reduction in discretionary spending creates a significant drag on regional GDP. Small businesses that barely survived the pandemic are now facing a customer base with drastically less disposable income. Retail sales soften, restaurants struggle, and service providers lose pricing power. This creates a secondary, chilling wave of economic stress that feeds directly back into the housing market through job losses and reduced income. CIBC's chief risk officer confirmed this dire connection, stating that rising delinquencies reflect higher unemployment and continued weakness in housing sales. The bank isn't guessing, they are watching real-time data showing that people are losing their jobs and defaulting on their debts simultaneously. But there is another layer of systemic fragility that often gets overlooked: the explosive risk of co-ownership structures. We know that nearly 18% of properties owned by younger individuals are co-owned with their parents. When one party in this arrangement faces financial stress, the default risk doesn't just double, it multiplies exponentially. Co-ownership introduces an emotional and financial fragility that standard underwriting models simply cannot capture. Picture the heart-wrenching dynamic: a 30-year-old tech worker loses their job, and they are co-owned with their 65-year-old parents who are living on a fixed retirement income. Who covers the now unaffordable gap? Do the parents tap into their precious, hard-earned retirement savings to cover their adult child's share? Should they? If they also have an existing mortgage or HELOC, they are putting their entire life's work at risk. These impossible, deeply emotional conversations are happening in thousands of Vancouver living rooms right now. This systemic fragility is what gives the Bank of Canada an impossible dilemma. If they cut rates aggressively to ease the crushing mortgage renewal stress, they risk reigniting inflation, which reached 8.1% at its peak. If they hold rates steady to keep inflation contained, they watch mortgage delinquencies continue to climb, potentially triggering a financial crisis that spreads far beyond housing into the broader banking system. There is no clean solution, every option carries massive downside risk. The Vancouver mortgage crisis is not an isolated event, it is a profound warning signal for the entire Canadian housing market. When so many core elements, negative equity, delinquency rates, renewal shock, and investor cash flow, are all aligning negatively, the system is not just stressed, it's fundamentally broken. Conclusion. This is the whole picture. When 20% of recent buyers are underwater, when delinquency is climbing to decade highs, when $300 billion in mortgages must renew at rates many simply cannot afford, and when the co-ownership bedrock is showing stress, you have a system that is no longer capable of sustaining itself. This is not fearmongering, this is the cold, hard conclusion reached by reading the data. The mortgage stress is a tragedy of colossal scale, impacting millions of lives. But Vancouver's breakdown is a hydra, and the other heads are equally devastating. The condo market collapse, developer bankruptcies, and the true cost of those 3,500 empty buildings tell an even more dramatic tale of how Metro Vancouver's real estate market is fundamentally breaking down from multiple angles simultaneously. That deeper investigation is on screen now. It exposes how mass developer bankruptcies and millions in unrecoverable debt are destroying the market from the inside. Watch it to get the complete, unfiltered picture of what's happening across Greater Vancouver.